When Trump came to office, there was a widespread anxiety that his economic program of tariffs and tax cuts would be bad for the American economy. Economists warned that his tariffs would push up inflation and slow down the economy, while his tax cuts would make the American tax system even more aggressive, while putting a potentially lethal strain on America's public finances. However, while there was some turmoil early on, in recent months the American economy seems to have stabilised and has actually been looking pretty strong, at least by international standards. So in this video, we're going to try our best to explain how the American economy apparently dodged disaster, and whether it can last. In the latest issue of our magazine, Too Long, we dive deep into the current state of America, discussing our real thoughts on the state of American democracy, soft power, universities, and the countries that could steal their crown, from China to the EU. Find out more about Too Long, the end of the American order, by clicking the link in the description. So, let's start with a quick recap. Last year, there was a genuine sense of optimism among much of America's business community that Trump's promised agenda of tax cuts and deregulation would be good for the American economy. Trump had inherited a pretty strong economy from Biden, with the strongest GDP, productivity, and wage growth in the G7, and investors dismissed Trump's talk of massive tariffs as campaign bluster, betting that, like in his first term, Trump would be sensitive to market pressures, which would essentially prevent him from doing anything too unorthodox. This is why ahead of Trump's inauguration, the dollar surged, with both the S&P 500, an index of the 500 leading companies listed on the US stock exchange, and the dollar index, which measures the value of the dollar against a weighted basket of currencies, rising after Trump's victory on November 5th. However, once Trump actually came to office, it quickly became clear that this optimism was misplaced. On day one, Trump started whacking tariffs on his trading partners, and it quickly became clear that Trump was genuinely committed to his tariff agenda, and less sensitive to market pressures than in his first term, with both the president and senior members of his team dismissing the declines in the S&P 500 as merely noise. Similarly, it quickly became apparent that DOGE, the main vehicle for Trump's deregulatory agenda, was both less effective than expected and also more focused on filling the civil service with Trump loyalists than actually cutting federal spending or red tape. The economy duly started showing signs of strain in March, when survey data suggested that both business and consumer confidence had plummeted, and that the Atlanta Fed's GDP Now forecast, a real-time estimate of GDP, suddenly started predicting a vicious recession. But things got particularly dicey on April 2nd, when, as you might remember, Trump declared Liberation Day and announced a flat 10% tariff on all imports coming into the US, as well as further flat tariffs on basically all of America's trading partners, calculated spuriously by dividing each country's bilateral trade deficit with the US against its total exports to give a percentage, which Trump then halved if he felt like it. This sparked a steep decline in the S&P 500, which fell by about 10% in a week, as well as a furious tit-for-tat trade war with China, and by mid-April, both countries had imposed tariffs over 100% on each other, basically ending all trade between the world's two largest economies. However, in the past couple of weeks, the American economy has apparently regained its footing. The S&P 500 is back up to a record high. Inflation has only come in a smidge above the Federal Reserve's 2% target for the past 3 months, and the odds of recession have now fallen dramatically, with both the IMF and OECD now forecasting that America will once again see the strongest growth in the G7 this year. And while the dollar has still trended downwards, it's above the recent historical average, and while Treasury yields have tended upwards, they're still within the normal range for the past couple of years. Most recently, last month's jobs report massively outperformed expectations, with 147,000 new jobs added in June, while other recent survey data suggests that business and consumer confidence is recovering. So what actually happened here? How has the US economy apparently survived Trump's tariffs, which economists almost unanimously expected to trigger economic disaster? Well, the first thing to say is that it's important not to overstate all of this. Sure, the American economy isn't headed for a recession, but its growth rate has slowed from between 2 and 3% to somewhere between 1 and 2%. It's also worth saying that inflation is still higher than the Fed's target, and it's expected to rise to nearer 3% in the coming months. Some of this is also the consequence of Trump's constant flip-flopping on tariffs, which has meant that his most dramatic tariffs have either not come into effect, as was the case with his proposed Liberation Day tariffs on the EU, or has been wound down somewhat, as has been the case with its tariffs on China. To be clear, America's tariff rate is still pretty high by historical standards. The effective tariff rate currently stands at about 12%, according to calculations by the Tax Foundation, its highest in nearly a century. But the potential inflationary effects of this have also been offset by businesses who have tried to keep prices flat even if they've been affected by these tariffs. This is also because of front-loading, i.e. businesses stockpiling imports ahead of the tariffs, but also because even if they've exhausted these front-loaded stockpiles, businesses have so far been happy to accept lower profits rather than increasing prices, because they don't want to irritate customers when there's a good chance that Trump will reverse his tariffs later. It's also worth mentioning that quite a lot of this nominal growth is driven by debt-funded government spending. Thanks in large part to Trump's One Big Beautiful Bill, the US is expected to run a budget deficit representing between 6 and 7% of GDP for the foreseeable future. The relationship here isn't straightforward. It's not like a 6% deficit automatically adds 6% to GDP. But a deficit of this size will still create a pretty big boost to aggregate GDP, especially because much of the fiscal stimulus in the Big Beautiful Bill is front-loaded over the next year or two. And while Treasury yields aren't high enough to trigger an acute fiscal crisis in the near term, America's fiscal situation is still clearly unsustainable. But the final reason that the US continues to do all right is that, well, there just aren't that many better options out there. This is why American bonds, stocks, and the dollar are still doing okay. Whatever anxieties investors might have about Trump and his agenda, there aren't that many obvious alternatives. Europe is looking at even slower growth than the US, and no national bond market is as deep or liquid as the Treasury market. The CCP's penchant for capital controls means that China isn't the most attractive place for foreign investment either, and other emerging market economies are struggling to deal with turmoil triggered by Trump's tariffs. So without a clear alternative, America's economy will continue to benefit from its status as the go-to haven for foreign capital. This is a complex and nuanced story though, and as such there's plenty more you can read about it online, with 73 sources reporting on it. The issue is, how can you be sure that what you're reading isn't totally biased? Well, that's a problem we face when writing these videos too, and luckily, that's where this week's sponsor, Ground News, comes in. For this story in particular, they've identified that there are at least 17 left-leaning and 5 right-leaning sources reporting on it. In fact, in addition to this, they've also shown the main differences in the headlines among left and right-leaning outlets, with the left-leaning outlets emphasizing the outstanding recession risks from Trump's tariffs, and right-leaning outlets taking a more optimistic tone. We're able to do that thanks to Ground News, whose incredible website and app lets you discover the news and pulls back the curtain on media bias. That's because every story comes with a quick visual breakdown of the political bias, factuality, and ownership of the source's reporting, all backed by ratings from 3 independent news monitoring organizations. But one of the best parts of the app is their blind spot feed. It presents you with stories and articles that haven't been reported on by one side of the aisle or the other, helping you better break out of your media bubble and discover what those on the other side of the political spectrum are really saying. For instance, if you lean left, you might have missed this story about JD Vance attacking Zoran Mamdani, because 0% of the reporting comes from outlets leaning left. However, if you regularly check the blind spot feed, you get shown what you're missing, helping you keep on top of what the entire political spectrum is thinking about, and why. If you're interested in everything that Ground News has to offer, you can get 40% off the Unlimited Vantage plan by using the link in the description, or scanning the QR code. This offer is only available here, so make sure you use our link to get started and support an independent news platform working to make the media landscape more transparent.